Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. It is the 12th of June, the day before Friday the 13th, which, listen, maybe there's something to it. There was some strawberry moon or something last night, and that's not a metaphor. It was actually the moon looked like big strawberry.
That's cool.
Yeah.
Did it have like dots in it and stuff like that?
No, I don't think it had the. The only fruit that has seeds on the outside is strawberry for you playing our home game.
I'm gonna take a. By the way, I can get a little intro here. I'm Dan Nathan. That's Guy Adami. It's 11 a.m. June 12th, the day before Friday the 13th. Your favorite moon, and I'm going to go out on a limb here, is a harvest moon.
That's a great song by Neil Young, by the way. Harvest Moon.
That's where I was going. All right, Guy, we're going to throw your questions in here, people. Guy is dying to answer questions. We're going to talk inflation. We'll talk a little bit more about this trade deal, at least the market's reaction. And then, some stuff going on. I mean, we're already threatening tariffs again. We have a trade deal, and then we're threatening unilateral tariffs. The market didn't love that overnight, Guy, but we were only down 50 bips.
No, it's incredible. You see what goes on. You hear the news out of the Middle East planning. It's more of the same type of news, but that the geopolitical risks that we've talked about have not gone away. In some cases, they've only gotten ratcheted up. I mean, you do have a VIX that's effectively unchanged today, slightly higher, I guess. But the resilience of the S&P. Given at one point it was probably down about 30 handles or so. I mean, it's you have to admit it. I have to admit it's impressive. Now, maybe it's against the backdrop of cool CPI yesterday, cool PPI today. I'm not quite sure, but here we are, Dan.
Yeah, listen, what's obvious to me is the S&P 500, okay, we're at 60.42, the high at 61.50. And, maybe we're focusing too much on the prior highs. Maybe that's just kind of, not particularly useful, other than looking under the hood and seeing what's working and what's stalled and that sort of thing. I just think about this. We have a dollar today that's trading at lows, 3-year lows, which is pretty interesting. It's a heck of a lot of. You have 10-year yield at 4.37. Is that where it is right now? Maybe the backdrop for S&P 500 earnings, which have been coming down. We've been tracking our main man, John Butter's data. They've come down a little bit more than on average over the last 5 and 10 years. Maybe we're getting to a point where expectations are low. And then really just the negativity in and around a lot of this trade talk. Maybe that's one of the things that's kind of fueling it. You know what I mean? In a way. So I don't know. I'm not making a bullish case, but that is probably one of the ways in which you have an S&P that goes from up nearly 3% right now to at some point maybe in a quarter end. I don't know. Maybe up 4, 5, 6%. I don't know. What do I know?
And look, let's do our first slide. I mean, because now traders, the market's expecting 2 rate cuts this year. Again, after what we talked about. So, I mean, it seems as though, the market's getting excited about the Fed potentially being in play again. And I understand that at a point. I think it's that be careful what you wish for again. But that's just me. But you definitely have the data working in the favor of the rate cut camp. We shall see, though, if that's exactly what the market needs. Again, I keep coming back to all the people we talk about that are on the other side of this coin in terms of what's really going on. But you just touched on something that I think everything you say is important, but this specifically, the weakness in the dollar cannot be, I don't think, overstated in terms of what's going on. And there's this continued push away from the US dollar, which I think should concern people. I don't think it's market bullish. It doesn't appear that way right now. It's hard to make that argument with the S&P reversing the way we have today, but it's definitely something I think you have to pay attention to.
Yeah, and I guess it comes back to what are the reasons for it, right? So who's selling it and why? Like that to me is pretty interesting. And you talk about the conditions in which the Fed, might be able to lower interest rates. I mean, a big part of that obviously is inflation getting to their target, more comfort with the economy in general, right? We have unemployment, let's say, that's not going much higher here. You'd say, is the policy restrictive? And there's a lot of talk about how the Fed was way too late to acknowledge inflation back in 21. They had to raise interest rates, but when they started, what were the estimates, guy? I think going up like 250 basis points or something like that. They ended up going obviously to 5.5. Just think about that, to 5.5. And here we are, almost a year later. Well, for a year, well, no, 9 months from the first cut. Does that sound right? And, we're only down 100 basis points. If anything, it feels like the Fed kind of panicked a little bit by lowering interest rates. But here we are now. If they had gone the opposite way in September, if they said, we're not worried about unemployment, right? That's what they were worried about, it ticking up. And we're lowering interest rates because we feel confidence in the fact that the dual mandate was intact. We're going to get close to our inflation target, and unemployment is full-ish. I mean, I don't know. They could have done that, and maybe we would have had a different setup right now.
Yeah. And again, there are going to be critics out there. I've been critical of the Fed. I'm more in the Fed's camp over the last however many months. I think they're doing the right things, but I think part of it, it's like that Shakespeare thing, uneasy lies the head that wears the crown. And it basically means, when you're sitting in that type of position, you always have people shooting against you. So we'll see. I think this chatter about Bessent taking over for for Jerome Powell this time next year, that's out there. I mean, openly talking about, somebody succeeding him. The market doesn't seem to care about that. Maybe the market's interpreting that as bullish. I'm not entirely sure, but here we are. But we've said a number of times, Elizabeth Young Thomas is on maternity leave, but we met Mario last week at the Fast Money Live event. Absolute gentleman. I don't know if he's watching or listening right now, but he continues to do great work. So let's sort of dissect some of the stuff that he sent us, Dan.
Yeah, well, you want this in your email box, guy, or you want to find it on the webpage here at SoFi blog, sofi.com/on-the-money. Why don't you do that really quick? Because last week you really enjoyed that. You said it's my turn.
Can I do it?
My turn. Yeah, go ahead.
Sign up today. SoFi.com/on-the-money. I don't know if the caps are imperative in terms of the S and so, the F and FI, OTM, but there you go.
No, I think it looks great. It's a great way to get this data here, but we get a preview of it, Guy, on the market call on Thursdays. Let's rip through this thing, because then we'll just kind of put a pin on inflation right now for a little bit, because obviously what the Fed has to say about inflation next week on June 18th is going to be most important. But this is what Mario is focused on today. May CPI rose 0.1% month over month on both a headline and core, excluding food. Oh, wait, you love this. Excluding the volatile food and energy. What's up with that? Do we have to hear the word volatile every single time we hear the exclusion? Is that one of those things for you?
Well, there are a lot of things for me. Maybe I should be in like therapy or something, because there are too many things for me apparently.
You're doing great. But Mario did not put the word in, the volatile, which I think is amazing. Okay, the downside surprise to core inflation was the fourth straight below consensus print, with this release coming in below all Bloomberg economist estimates. So you see that there. I guess the question I have, Guy, is if you think about, the Fed has already said that they are going to be patient, right? They're not going to wait until, well, they used to say they're not going to wait until it gets to its target. Didn't they used to say that? So when you look at this inflationary environment and it's cooler than expected, a lot of folks thought it was going to be hot in and around this kind of trade war, sort of, whatever you want to call it, situation here, but it's not coming in that way. And so if the trade talks and all this stuff goes to the back burner and it's not like front of mind for investors, can you imagine in the last 3 years, all we've talked about inflation, and now it seems to be where it's supposed to be.
Exactly. And the next slide from Mario is a little bit confusing. I just want to put it up. So they're talking about the components of the annual month over month annualized rates. So this is going to be hard to look at, but they're talking about disinflation becoming more widespread. So just remember that phrase for a second, and let's go to the next slide, because this is sort of the other side of that coin. Consumer sentiment at historical lows ish. I mean, we've seen obviously bounces along the way, but we talk about these cross currents all the time. Well, this is one of those cross currents. Inflation unexpectedly slowing while consumers feel historically bad about the inflation that is supposedly slowing. It's really hard to wrap your head around this.
Yeah, I mean, Listen, I guess the risk is, and Doug Cass sent us some stuff on this yesterday, and I think it's important, is like the risks are always the ones that you're not kind of focused on, right? So if everyone's kind of looking at this data and saying, well, the Fed has all the reason, we just kind of address this, to start lowering interest rates. Well, the dollar weakening, if you have, interest rates going lower, if you have all of these other situations as it relates to trade, you could see inflation, you could see it reemerge. But at that point, if it's going to go from 2.3 or 4 up to 2.8 or not, does it really matter? Like we spent a lot of time talking about how important that 2% inflation rate is, that target that they've been focused on, that they've basically just gone like this up in the air. When we have a growth rate in GDP that is above it, you're doing okay, right?
Mm-hmm.
Isn't that fair to say? And, if you look at the average pre-pandemic for GDP, the prior 10 years, it was 2.2%. So if you had 2% inflation, 2.2% growth, that should be fine. The other fact is when we had yields as high as we did in 22, obviously we had the bear market. In 23 and 24, the stock market did just fine. The economy was just doing just fine. So I think there's a reasonable argument to be made that they could start normalizing rates. And you might say, well, 4.5% over the last 30 years in the Fed funds, that's normal. You know what I mean? So again, I'm not an economist, but I think it's worth kind of digging into this data.
No, and we have a couple questions. So, this is interesting. XLE from Toby. It's not a question. It's just basically the XLE with a question mark around it. And I think, I think my feelings on energy are pretty well known. I mean, the XLE is fighting with unchanged today, with crude oil being lower on the day, not hugely lower, but marginally lower. I still think there's some stuff out there to be concerned about on the geopolitical front, which be supportive of the XLE trade. And we're just sort of hanging around. If you go back a couple of years, Dan, this 86, 87 level, I mean, this is sort of the mean of where we've seen since, I don't know, the summer of 2022-ish. You know what I think? I think there's another leg higher here, but it's been a long time coming. You got to take out the 2014 highs back in the summer of 2014, which I think is sort of north of 102-ish, which seems light years away, but I don't think it's that remote to think we can get there.
Yeah, it's just one of those groups, Guy, and it just doesn't feel like, like whatever the risk is, you know what I mean? Like, let's say the risk is down to 70 at the low end of the band, going back to kind of, late, sometime in 2022 versus, let's say, making a new high. Where are we right now? We're just, it just doesn't seem like, maybe it's like up or down 10 is kind of how I feel, you know what I mean? So there might be better ways to play, unless you have some massive thesis about, large integrated energy and that sort of thing that, diverges from the fact that this thing has been going sideways for a while. But, it's valuation. I don't know. Do you buy these stocks on valuation? I mean, I probably don't. One thing that Doug hit us on, Guy, and I think it was talking about rotation here, like what you want to say, it's tech versus financials. And if you're looking at it today, like tech is once again being led by, I think, semis to some degree. NVIDIA, up 1.4%. And then you have Taiwan Semi, which is up nearly 1%. Again, if you're looking at the SOX, or the SMH, actually, those two are big components. And then looking at the financials, let's forget the SOX. Look at the KRE, look at the BKX, they just feel stuck in the mud. I mean, like, you would think that this group would be doing better in an environment where, let's say, trade is kind of off the table. You're looking at the optimism in and around getting a tax bill done. I don't know. For whatever reason, I would think financials, banks in particular, would be acting better.
We had, I can't think of who it is last night on Fast Money, but, talked about deregulation and sort of the path forward for not only the broader market, but exactly what you're talking about, banks and what have you. I get it. I don't see it personally, but a lot of people think we're in sort of the early stages of this, resurgence of the bank trade. I come back and continue to look at some of the problems that the consumer is facing, and I'm hard pressed to understand how that's going to be positive for banks, who are in large part reliant on exactly that. But there's a lot of optimism out there. And I think at the top of the funnel is deregulation. You talked about tax, this potential reacceleration of the economy. But, all those things have sort of been talked about ad nauseum for a while. So as the market's a discounting mechanism, you have to think it's already in there.
Yeah, and on the tech front, I mean, there is one bright spot away from the semis, and that's Oracle,
Yeah,
which
throw that
is
up.
yeah, so it's making a new all-time high. You know, one of the things I think is really interesting, and we talk all the time about the construction of ETFs, right? So look at that, man. All right, let's just do Oracle, and then we'll get to like the IGV versus the SMH. My view was that, like, given the expectations where the stock has rallied, given their really exposure in their cloud business, it's like 15% of their revenues, you know what I mean? But the stock seems to trade a lot off of it. It's kind of a hopium sort of trade here. By the way, Oracle, it was the O in your hope
Yes, it
trade.
was.
Yeah,
Yes,
so
it was.
I just want to be really clear about that. That was from a couple years ago. This was not on my bingo card, man. Like, you know what I mean? Like the idea of the performance that they had and what they have to say. Oracle's also one of those companies where you just don't feel like they have a great visibility into their business because there's just so many gaps. Look at this chart right here. I mean, look at all the earnings gaps. And so I don't know.
Sensational.
Like, I'm
I
not
mean,
chasing this one, is
I don't think you should either. And it's, if you could tell me how much volume it's traded already today, it's probably going to trade north of 5 or 6 times normal volume. You've created this sort of gap to the upside. By the way, we have seen this before. And if you go back to sort of January, you'll see that gap to the upside that was subsequently met by a gap to the downside. And I'm not saying that's going to happen now, but we're right up against, as Dan said, an all-time high. But you're effectively up against those prior all-time highs if you want to sort of fudge it a little bit. We'll see where we close today, but I think Dan is right. I think the average volume is 8 million shares a day. I don't know what we traded already, but
31 right now.
yeah,
31.
so there you go. It's going to be well north of 5 times by the end of the day. So if you've been fortunate enough to own this thing, and we thought there was a chance that it could get up to those prior highs, I think you got to move your feet here, Dan.
Yeah, go back to this January period, and this was when they kind of released the Stargate thing with Masa-san from SoftBank and Sam Altman from OpenAI. Look at that period where we saw those. And I don't, if you could throw volume up there, Stephen, this would be pretty good. So when you talk about 31 million shares today, we're kind of halfway through the day ish. This is going to be well above the 52-week highs of like 40 on the volume front, 41.2 or something like that. And, like, I guess you look at volume a couple different ways, right? You just say, like, this is folks who think there's going to whole heck of a lot of runway. Like, this is not a big short interest name one way or another, but look at how quickly that reversed, right? Like, so that January move. So 2 of the biggest volume days happened in that week. Right. And so I'm not always like so convinced that volume on a big up day or a big down day is some indication about like what the direction is going to be for the next few weeks or month or something like that.
To me, it just sort of speaks to, you get a huge volume day on an extreme, whether it's a high or a low. It speaks to exhaustion either way, sell side exhaustion or, buy side exuberance that sort of, peters out over time. So that's why I'm so focused on it. But look, I mean, I'm not saying I'm right. That's one of the things, though, that I definitely look at. Real quick, we have a bunch of questions today. This is probably, I don't think this is happening. DocuSign just had a huge move lower. It really has not been able to get out of its own way. But the question is from Carter Evans. He's asking, do you think Microsoft will buy DocuSign? I don't know if that's been out there. You're probably a lot closer to this world than I am, but I don't see any particular reason for that unless you know something and I don't know.
No, I mean, listen, Microsoft, by the way, has been pretty good in their acquisitions of late. And there was something under Ballmer. They were not particularly good. I had 2 guests over the last 2 days. One's Rishi Jalaria, and that's on the Risk Reversal podcast. He's the RBC software analyst, and that was in the podcast store today. And then tomorrow I have Imran Khan, who's the CIO of his hedge fund called Pro M Asset Management. He's a former COO of Snap. Both of them sitting in the same seat 24 hours apart. Both said that they have actually, the LinkedIn acquisition going back years, I think it was $27 billion, ended up being a genius acquisition by Microsoft. So they went from being really bad at acquisitions and writing off a big chunk of them over the years. And then under Satya Nadella, a couple good ones here. So GitHub was one of them. So I don't know. I don't know how this kind of fits. This is more of a service that, fine. Maybe it would be something that would be nicely built into like Office or something like that. But I would look at more something like Zoom, maybe a merger. You know what I mean? Like they both have similar enterprise values, or maybe a Cisco buying, let's say, Zoom. That was another name that Rishi and I talked about. So I have no idea. But this is another company. Like, look at that gap on earnings late last year, and look at the gap lower today. And And, these are companies, they're seeing really lumpy sort of pockets of business and that sort of thing. So again, this is probably a perfectly fine name. I didn't look at it particularly closely, Guy, but
Yeah.
who knows on that regard.
And this is from Carter Evans. Again, are you going to watch Restoration Hardware into earnings? So the short answer is yes, only because I do think it's a bit of a tell on the higher end of things. And, this is a stock, quite frankly, that has not been able to get out of its own way either. I mean, this thing, I think, Dan, made an all-time high in the fall or so of 2021. And since then, it's been sideways to slightly lower. I mean, we've had some bounces along the way, but as we're sitting here now, I think we're talking about a stock that's the lowest levels we've seen in the last 5 years-ish. I think we got down to about 123 on that low in April, and we've bounced, but here we are. So not particularly meaningful bounces. I think, what I think about the consumer. I think on either end of the spectrum, you're going to have some issues. And if Restoration Hardware says some, negative things, I think you're going to start connecting more dots. I mean, you brought up Costco the other day. We're obviously hearing from the different retailers at different levels. I mean, there's clearly something going on. So yes, I'm watching Restoration Hardware.
Thing about RH that's so interesting, Guy, is that here's a company that is basically trading at one-time sales. Those sales are still expected to grow this year, fiscal 2026, 11%. And trades at about 18 times earnings this year, 12 and a half times next. It's down 55% on the year. And, I look at this and I say to myself, wait a minute, how does it have a $3.3 billion market cap and they have nearly $4 billion in debt? So if you start to see these earnings estimates kind of get ratcheted down, because that's at least what the stock is telling you right here, right? So you have a situation where this balance sheet is a bit of a mess, and I don't know. This is not interesting to me whatsoever, Guy.
No, listen, I agree. The other thing we have to talk about, and it's not that I want to talk about it, obviously a tremendous loss of life, and this is a tragedy in a word, but, Boeing today, I think we obviously at one point today, we were indicated a lot lower than where we're currently trading. I bring it up just to bring it up because, the airlines are become a trade. Boeing obviously has gotten off the mat. You see the news out of India, which is a tragedy, but understanding that we are all sympathetic to that. The way Boeing closes today, I think is going to be really important in terms of, the next 15 or 20% in the stock.
Dude, I just went to the Wall Street Journal, and they have a video of this,
No, it's horrible. It's horrible.
Oh, geez. And it landed in a residential area. Yeah, that is horrible. And, I guess the history of Boeing with these sorts of crashes is, again, we feel shitty talking about it through the, this tragedy through the lens of the stock. But, if you go back to, maybe they could take it back 10 years. I mean, those two 737 MAX, there was like 400 people, lost in those two. And you see, obviously COVID is the one where you just take it down, but, yeah, what a horrible thing. I mean, this goes from a story where, folks like you and Tim on Fast Money, you guys have been really constructive on, the kind of, getting back to the basics, turning around some of those QA issues that they had, getting a bunch of these orders back up and running over the last 5 years, increasing the cash flow. I mean, the list goes on. And then you have something like this and you start saying, wait a minute, the Dreamliner, do you remember like 13, 14 years ago? They were having a lot of issues with that. It was really like majorly delayed and the like. So this is probably the sort of thing that makes a bunch of these come offline. If it was not like, like pilot error or anything like that, this could be a problem for Boeing for a little bit.
Yeah. And again, it's really hard. I want to emphasize, I mean, we're human beings as well, but, we're tasked to sort of talk about impacts and what it means to maybe the broader market or individual names. But I want to emphasize understanding how sympathetic we are towards this. I mean, the way Boeing closes today is going to be a good tell. So let's move on quickly from that. And we have a question. It's more of a comment from Scott Rogers. GDX having a day. And yeah, it is having a day. And as we're sitting here now, I think we've gotten to levels. I want to say this is like a 13-year high or so in the GDX. And if you want to throw up a longer term chart, you'll see exactly what I'm talking about. We've been pretty consistent in terms of our view in gold and our view in the miners, and it's all starting to play out, and it's doing in a pretty meaningful way. The gold pullbacks, and we've talked about this, are fewer and fewer, and I guess shallower and shallower, and it's telling a story. And when you have people like David Einhorn, who's on with Scott Wapner a couple weeks ago from the Sohn Conference, who's waxing poetic about gold and has been for a while, Paul Tudor Jones yesterday or 2 days ago on Bloomberg, you're starting to connect dots and say, with all the stuff that's going on, I mean, all roads are leading to gold. Now, people out there will say, what about Bitcoin too? Yes, 100%. But, Bitcoin, and I know you have views on this, we just traded up to 110,000-ish or so. That was the high I think we made back when, Dan, you know better than I do, probably in over
January.
Into January.
Yep.
I don't know. We'll see how this behaves. I don't have that strong a view. I have a very strong view in gold.
Hey, Stephen, pull up the intraday of the KRE. We were just talking about this. It was down 85 basis points. Now it's down 1.35%. So it just took a leg lower. The S&P took a little bit of leg lower. I'm not sure what's out there. You and I have been just gabbing to each other. Here you go. Look at freaking Jacob. All right, Israel considering military. I mean, this is
we've seen that's yes. Thank you, Jacob. He's right, and I'm not. This has now been out there for a few weeks, and it's seemingly getting ramped up. You heard, I guess, the Trump administration is calling back civilians from, I think, 4 or 5 different countries. I mean, there's clearly concern around this, and oil traded on the back of it. To a certain extent, the sell-off in the S&P overnight was on the back of it. But I'll say this again, I don't think the market is at all pricing in the ramifications if this were to happen.
Well, I mean, listen, and this is not meant to be political. We pull back from our commitment to Ukraine, right? Emboldens Russia. We are letting the Israelis do whatever the hell they want in the region, right? Like they continue to pound the hell out of Gaza, and they don't really have a clear path for what they're trying to achieve other than what they say every time is to eviscerate Hamas. Every time they kill one of their leaders, another one pops up, right? And so now, they went into Libya and they did a job on Hezbollah. Like, listen, we can all agree they had every right in the world, to retaliate against one of the most disgusting, attacks on civilian population in a long time. But the situation now allowing them to do whatever they want in the region, and we're in the midst of doing a trade or a nuclear deal with Iran. What does that do for our positioning? You know what I mean? So, and we talk about what's going on in crude, and this is maybe it's the dollar, maybe it's geopolitical, maybe it's the excitement that we're going to reflate and the global economy is going to come back. But this is the sort of stuff, like, war is not deflationary. You know what I mean? War is inflationary. And, so this is something that, I mean, it's just so sad. We started out talking about, the loss of life in this plane crash. I mean, this is also part of it. And, this seems to be one of those things that we do not have a good handle on with one of our closest allies, you know what I mean, in the region. So yeah. I'll just say that.
No, it's fair. And I don't think the market has a handle on it either. We have a question, again, to shift gears on Humana. And, we've talked about UNH and not chasing it. Well, not chasing and not trying to sort of find a level because there really hasn't been a level. Humana is sort of in that same boat. If you look at Humana longer term, we've traded down the levels I think we last saw in the height of COVID in early 2020 or so. And the question is from Lee J. He also calls us, he says, you cats be cool. I'll say again, like, there's nothing that's happened in any of these names that have me sort of pounding the table that you got to get in on valuation or an oversold condition, because I don't think we've seen it yet. So if Jacob just wants to do a longer term Humana chart, you'll see, where we are and, where we've been. We're at those levels there. You could draw that horizontal line from the lows of 2020 and we're right there. So you want to play against that? I guess that's okay, Dan, but there's just no friggin' bounce in these things.
Yeah. And, you're going to hear a lot about valuation. You're going to hear a lot about, how these companies, and there's only a handful of them, are positioned within their space, but they just seem like one of these situations where, there's lower lows if they can't change the narrative in and around this. And obviously the horrible situation that happened with UNH and the gunning down of one of those executives. I mean, there did seem to open up some sort of floodgates about these businesses and how they're run, and it doesn't seem like investors, it takes a whole heck of a lot for them to decide to sell these stocks. You know what I mean? So again, one thing I just, Guy, just kind of pulled up some of the headlines, just as I was looking to see what the reason was for the leg down in the market. And there's two headlines that stick out to me. These are top stories on Bloomberg.com. One, Trump says his deportation drive is sparking worry over jobs. Okay. So this was one of the things that we heard, you know what I mean? Like, so mass deportations was, part of the campaign, and, promises made, promises kept, and we see what's going on there. But this is really interesting to me. The fact that he's willing to acknowledge that, it brings us back to, late March, right? When they said that they are not focused on the stock market, they're focused on the 10-year yield. And, the fact that I don't know in what context that came out, you know what I mean? But like, okay, that seems inflationary, right? And then here's the other one. President Xi plays long game on U.S.-China trade as Trump seeks quick wins. We've been talking about that. A lot of folks have been talking about that in an apolitical way. You know what I mean? It's just a fact. And you've been saying this long before, April 2nd, right? And so we're looking 2 years at a time. We're looking at the midterms, right? And these guys are thinking out 10, 20, 30 years. They also have a centrally planned economy, right? They have a consumer or a citizenry that is basically at the whim of the government. If you go out in the streets there, they've already got Marines deployed, and it's not against their constitution. You know what I mean? So they have the ability to, like, and the wherewithal to stick this out. And then all of a sudden we kind of realize, holy shit, they have a lot of leverage over us as it relates to rare earth materials, because they don't just go into our autos. They don't just go into a bunch of manufacturing capabilities. They also go into some of our most important defense apparatus, right? So we are in a jam. Now, they've already shown us they can make do for the most part with some of our, chips as it relates to, like, AI and the like here. So this is one that I just don't, as we get to some of these deadlines, I just don't think it gets better. We had an agreement in Switzerland in May, and it only took about 2 weeks between both sides saying that they're violating that agreement. We have a handshake agreement now. There's going to be a bunch of stuff going on in the background. So if you're playing this, if you're buying the stock market because you think this trade war is done and dusted, I don't think that's one of the main reasons you should be buying it for.
Yeah. And again, I mean, and it's in the rearview mirror now. And you're right. We've pointed out how, the Chinese play the long game, and people say, oh, you're un-American. It's got nothing to do with being un-American. I mean, the reality is, we're very short-sighted here. You said 2 years. I'll give it more like 2 weeks. We don't have the attention span or the wherewithal, because they can play the long game by definition, the way they're sort of set up. And as much as we like to think we hold all the cards, we hold a lot of the cards, not as many, I think, as the market wants to realize or is pricing in. And another hard pivot here, and if Jacob can pull this up, this is a question that, or more of an idea from Scott Rogers around Palantir, and we can pull it up and you can dissect this, because this is your world. I think you all know our views on Palantir in terms of valuation. It's got itself very expensive, but Scott, and I'm going to read really quick the question from him. Call option skew so extreme to the upside for Palantir. He did a buy rate with 120 call strike yesterday for $115.45, 13% out of the money prior to earnings. He's just looking to scalp. You can read it as now as much as I can. So what are your thoughts, I guess, is what he's asking for.
Right. So the call skew, you're saying there's more demand. We saw this in NVIDIA over the last couple of years or so, where you see traders more interested in upside calls. So you're seeing those get more expensive than puts. And you would think that, a stock that's performed like this on the valuation that we've talked about and some of the controversy in around the name, that if you were long this thing, you would see more demand for puts. And so what Scott's basically saying is he's seeing an opportunity to sell calls given the valuation, and you can take in a lot of premium, especially if the thing goes sideways. So, like, good heads up there. This is one of those names where it's like purely divorced of fundamentals, divorced of, valuation and the like. So, I don't know what to tell you here on this one. I've been wrong on it. I feel like that, I felt pretty good about after that gap on earnings. If you go back to late January, early February, the way it sold off into early April, that was like a 45% sort of drop, it would not surprise me if this stock, guy, we have 78 on the 200-day moving average. This obviously keeps moving higher the longer this thing stays up there and time goes by. I think you're going to have a retest of this, because in the last year, you have not seen this stock sniff the 200-day and go all the way back to last summer in August, when the stock was trading like 26 on that little sell-off. It looks almost cute, right? Like maybe that was earnings and it kind of bounced off of it. This is one that's really hard to trade. I did a put calendar, I want to say a week and a half ago in this sort of thing. And I was looking to kind of take advantage of the high vol also, and take advantage of the fact that if this thing grinds sideways, then I end up seeing that short near dated put expire, and then I'm long, like an outer longer dated one. But that's not going particularly well either, guy.
No, but listen, I think Scott's thinking the right way. You're taking shots, you're taking making bets along the way, and allowing volatility skew to work in your favor. And I do think, listen, what we saw in April, that moved down to about $80 or so, maybe even lower than that, was not an aberration. And, I think just in terms of a number of different things, you're setting up for a similar type of move. I think obviously the level's a little higher than it was back in April. It's probably closer to $80 now, but I don't think it's out of the realm of possibility to think you can't see a similar move that we saw earlier in the spring in a name like Palantir.
Yeah, I want to give these guys a minute. I just put something in our chat. If you guys could put this up. This is from David Boole at Baycrest. He's an options strategy. It's David Boole. And, guy, I think he's been on Fast Money before, and I get his morning note, so I want to give him like a full shout out on this. And they're talking about a monster trader. They're calling it a whale that just spent 129 million on downside premium in the SPX. And if you want to just look at the expirations here, this is August 15th. It's the 600, 500, 5800 put spread that traded nearly 20,000 times. The 29th of August, so 2 weeks after that other one, the 5600 put spread. Okay, you see that traded 14,500 times. And then the September 5900, 5700 put spread that trade 12,000 times. So what's interesting about this is, like, when you see that sort of size in the index, okay, in the index, that's 100% institutional. Like, obviously, you look at that sort of size, but look at how they've kind of laddered down. So mid-August, 6,000 to 5,800. Late August, 5,800 to 5,600. I think that late August catches the Jackson Hole sort of thing. So I guess, the expectations right now, the CME Fed Funds futures, is not that they're going to see a rate, cut. There's no meeting in August, right? So maybe they say something that's a bit more hawkish, you know what I mean? But interesting levels, just for whatever that's worth.
So vol play for sure as well. I think you would agree. Vol's come all the way back down, so they're probably trying to take advantage of that. And it's obviously, it goes without saying, it's a directional bet too. And I think if that is in fact the case, and I'm not denying that it is, you're going to start hearing about similar types of bets in terms of the upside for the volatility index, because we've seen that before as well. So, I think it's important to point out, I'm glad you did, it doesn't mean they're going to be right, but you definitely have to take notice of something like that.
Yeah. And we're not unusual activity people. We think that's a bit of a fugazi, guy. At least I do. And I know you're very close to the options market, so you probably feel the same thing. You never know what this sort of stuff is against. This person or whoever, this institution, might have a massive long position in the markets. It could be in the options market, it could be in the futures market, it could be whatever. And maybe they're looking around, to your point, and they're saying this is the cheapest protection. Who knows? It could also be an outright bearish bet. It could be somebody who's just fucking stupid. You know what I mean? Like, my point is, you just don't know. And that's why anybody who tells you that directional sort of volume in the options market is the smart money, well, that doesn't make a whole heck of a lot of sense at all, in my opinion. So I'll just leave that there.
I think that's a good place to end everything. You mentioned you had a great conversation. That's going to drop tomorrow. Danny Moses continues to do the On the Tape podcast. Next week is sort of a strange week. You mentioned Juneteenth, so it'll be somewhat, I don't know. We'll still do our things, but we're going to have to figure out a couple things around the edges for sure. But regardless, we'll be back on Monday, Dan.
Yeah, we got Monday, Tuesday, Wednesday. We're going to be doing the market call. And I think we're going to have a risk reversal pod drop most of the days. On Friday, Steph Guild from Robinhood, she's their head strategist. She and I are going to sit down in the studio one-on-one, and we're going to catch, just a whole bunch of things that went on during the week. So that'll be great. Thank you all for being here. Risk reversal podcast drops tomorrow. Imran Khan and Guy, you and I will be back together on Monday at 11 a.m. Thanks.
No doubt.
Have a
Thanks,
great week.
folks.
All right, bye.